Hi guys, welcome to our channel where we unlock the secrets to stock market success. Today we delve deep into the advanced strategies that would revolutionize the way you approach trading. Hello, fellow investors. Today we are diving deep into the heart of successful trading with advanced strategies that separate the amateurs from the pros. Let's start with technical analysis, a powerful arsenal of tools that every successful trader masters. Candlestick patterns are like the language of the market. They reveal crucial information about price movements, trends, and potential reversals. By understanding these patterns, you can predict market sentiment with precision. From doji to hammer, each candlestick tells a unique story about market psychology. Moving averages smooth out price data and provide clear signals of trend and direction. Whether it's the simple moving average or the exponential moving average, mastering this can help you ride the trend waves with confidence. Moving averages act as your guiding light in the sea of market fluctuations. MACD is a game changer. It identifies change in momentum, providing early signals of potential trends, reversal, or continuations. It's like having a crystal ball into market shifts. MACD, your secret weapon against unexpected market moves. RSI measures the strength of price movement, indicating overbought or oversold conditions. It's your compass in navigating market extremes and finding opportune moments to enter exit trades. RSI, your guide to balancing the turbulent market waters. Fibonacci treatment unveil hidden levels of support and resistance based on natural mathematical ratios. They pinpoint potential reversal zones, allowing you to make calculated decisions with precision. Fibonacci will unlock the mathematical harmony with market chaos. These advanced charting techniques are not just tools; they are your keys to unlocking profitable opportunities in the stock market. By combining them skillfully, you gain a competitive edge that sets you apart as a savvy trader. Stay tuned for more insights and strategies that will elevate your trading journey. Remember, success in the stock market is not just a dream; it's a reality waiting for you to seize it. Guys, now let's dive deep into the realm of advanced strategies that will not expand your financial acumen, but also pave the way to lucrative investments. Because we are about to uncover the power of fundamental analysis. At the core of every successful investor's toolkit lies the ability to decipher the language of numbers and trends, the art of fundamental analysis. So, what exactly is fundamental analysis? You ask. Fundamental analysis delves deep into the heart of company's financial health and market position. It's like peeling back the layers of an onion to reveal its core essence. Let's break down in this process step by step. Firstly, we have the analysis of financial statements. This involves scrutinizing a company's balance sheet to assess its assets, liabilities, and equity. Income statements reveal revenue, expenses, and profitability trends. And don't forget the cash flow statement. They provide insights into a company's liquidity and operational efficiency. Next up, evaluating industry trends. A keen eye on industry dynamics can be a game changer. Understanding market trends, competitive landscapes, and disruptive innovations can steer your investment decisions toward sector poised or growth and stability. Now, lastly, let's talk about assessing economic indicators. Keep your finger on the pulse of the economy. Economic indicators such as GDP growth, inflation rates, and employment data can influence market sentiments and stock prices. By staying informed and interpreting these indicators wisely, you can navigate market fluctuations with confidence. Remember, mastering fundamental analysis is not just about crunching numbers. It's about gaining a holistic understanding of the forces that drive financial markets. Armed with this advanced strategy, you are not just investing; you are investing intelligently. So, embrace the power of knowledge, trust in your analytical prowess, and let's embark on this exciting journey toward stock markets together. Until next time, happy investing. Alright, let's kick things off with a quick refresher and dive into the world of option trading. Option trading might seem like a complex labyrinth, but once you understand the basics, it opens up a world of opportunities. Options are contracts that give you the right, but not the obligation, to buy or sell an asset at a predetermined price before a specific date. Sounds simple enough, right? Now let's take it up a notch. First up, let's talk about the straddle. Now, we are not going horseback riding. Through this strategy can certainly be a wild ride. A straddle involves buying both a call and a put option at the same strike price and expression date. This strategy is perfect if you anticipate a big move in the stock price but are not sure which direction it will go. Think of it as hedging or bets. If the stock jumps up or plunges down, you stand to gain. The key here is significant movement. No more sitting still. Next, we have the strangle. It sounds dramatic, but it's a fantastic strategy for capturing volatility. Similar to the straddle, the strangle involves buying a call and a put option, but this time at different strike prices. Usually both options are out of the money. Why is a strangle? It's cheaper than a straddle and still offers a great profit potential if the stock makes a strong move in either direction. Remember, when the market gets wild, a strangle can help you capitalize on the chaos. Now, let's soar high with the iron contour. This one's a bit more complex, but stay with me. It's worth it. An iron contour involves 4 options: selling a lower strike put, buying an even lower strike put, selling a higher strike call, and buying an even higher strike call, all with the same expression date. This strategy is perfect for when you expect low volatility. The goal is to profit make the goal is to profit from the stock price with staying within a specific range. It limits both your maximum loss and your potential profit, making it a favorite for traders who love stability. Finally, let's take a flutter with the butterfly spread. Picture this, it's like capturing a delicate butterfly in a net of profit. This strategy involves three strike prices: buying one option at the lower price strike, selling two options at the middle strike, and buying one option at the higher strike. Butterfly spreads are best when you expect the stock to stay near the middle strike price. It's a low-cost strategy with a balanced risk reward profile, ideal for when you foresee minimal price movement but want to maximize potential gains. And there you have it, 4 advanced option trading strategies to elevate your trading powers. Whether you are aiming for explosive gains with straddles and strangles or looking for stability with iron condors and butterfly spreads, there's a strategy here for every market scenario. Guys, now let's dive into the art and science of risk management, equipping you with advanced techniques to safeguard your investment and thrive in the market. Buckle up because this is going to be a thrilling ride. Financial adventures? Let's explore the powerful tools and strategies that can transform your approach to risk management. Whether you are a seasoned investor or just starting out, mastering these techniques will help you navigate the market with confidence and protection. First up, let's talk about position sizing. Imagine you were a captain steering a ship through both calm and stormy seas. Position sizing is your way of ensuring your vessel stays afloat no matter what. It's all about determining the right amount of capital to allocate to each trade based on your risk tolerance and market conditions. By diversifying your investment and not putting all your eggs in one basket, you minimize the impact of any single loss. This way, even if one trade doesn't go as planned, your overall portfolio remains resilient. Remember, it's not about how much you can gain, but how much you can afford to lose. Next, let's dive into the world of stop loss orders. Think of this as your financial lifeboats, ready to deploy when the seas get rough. A stop loss order is a preset instruction to sell a security when it reaches a certain price, limiting your loss and protecting your capital. Setting a stop loss order is like having a safety net. It takes the emotion out of trading and ensures you stick to your risk management plan. No more sleepless nights worrying about market volatility. Your strategy is in place to shield you. Now, let's talk about hedging strategies. Picture yourself as a gardener tending to a precise and diverse collection of plants. To protect your garden from unpredictable weather, you might use greenhouse, shade clothes, or even companion planting. In the financial world, hedging is all about using instruments like options, futures, or derivatives to offset potential losses in your portfolio. It's a way to ensure your investment against adverse market movements, allowing you to grow your wealth with greater peace of mind. Last but not least, let's explore portfolio diversification. Imagine you are building a treasure chest filled with gems from all corners of the world. Each gem represents a different asset class: stocks, bonds, real estate, commodities, and more. By diversifying your portfolio, you spread your risk across various investments, reducing the impact of any single market downturn. It's the ultimate strategy to ensure your financial stability and long-term growth. So there you have it, the advanced techniques of risk management that can empower you to navigate the financial markets like a seasoned pro. Remember, risk is an inherent part of investing, but with the right strategies, you can turn it into an ally rather than an adversary. Guys, now, imagine a world where trades are executed in the blink of an eye, decisions are driven by data, and your strategists work tirelessly around the clock. This is the world of algorithm trading. Algorithm trading, also known as algo trading, is the use of computer programs and algorithms to execute trades at lightning speed. These automated trading systems analyze vast amounts of market data and make trading decisions faster and more accurately than any human could. Let's break it down. At the core of algorithm trading are algorithms, complex mathematical formulas that decide when to buy and sell based on predefined criteria. These algorithms can be incredibly sophisticated, taking into account everything from historical data to real-time market conditions. But before these algorithms can start making trades, they need to be tested. This is where backtesting comes into play. Backtesting allows traders to stimulate their strategies using historical data. It's like having a crystal ball that shows you how your strategy would have performed in the past. This helps refine and optimize the algorithm before it goes live. Developing a robust trading algorithm involves a mix of financial expertise and coding skills. Traders and developers work together to create algorithms that can adapt to market changes and identify opportunities that others might miss. Now, how do these algorithms communicate with trading platforms? That's where APIs or application program interfaces come into the picture. APIs are like bridges, allowing your algorithms to interact with the trading platform. They enable real-time data exchange and trade execution, ensuring your strategy is always in sync with the market. With the power of algorithm trading, you can monitor and manage your investment from anywhere in the world. The markets never sleep, and neither does your trading strategy. Whether you are a seasoned trader or just starting out, algorithm trading offers a new realm of possibilities. It's not just about making trades; it's about making smarter, faster, and more informed decisions. So, are you ready to dive into the exciting world of algorithm trading? The future of trading is here, and it is algorithmic. Guys, now we are diving into the exciting world of market sentiment analysis. Whether you are a seasoned trader or just starting out, understanding market sentiment can be your secret weapon. So, let's get into it. Market sentiment is essentially the overall attitude of investors towards a particular financial market or asset. It's the vibe, the mood, the collective emotion driving market activity. Think of it as the stock market's emotional roller coaster. To gauge this sentiment, we have some powerful tools and techniques at our disposal. Let's start with sentiment analysis tools. These tools analyze news, social media, and even forums to measure the mood of the market. Some of the top tools include: number 1, Bloomberg Terminal, the gold standard for real-time financial data, offering sentiment analysis features. Number 2, Thomson Reuters Icon, another industry giant providing comprehensive market sentiment insights. Number 3, Stock Tweets, a social media platform specifically for investors, giving a real-time pulse on market sentiment. Number 4, Sentify, an AI-driven tool that analyzes big data from over 500,000 news sources and social media. These tools use complex algorithms and natural language processing to sift through vast amounts of text and quantify sentiment. But what do we look for? Interest sentiment indicators. These indicators tell us whether the market is feeling bullish or bearish. Here are a few key indicators. Number 1, VIX, Volatility Index. Often called the fear gauge, it measures market risk and investor sentiment. Number 2, put-call ratio, a ratio of trading volumes of put options to call options, indicating bearish or bullish sentiments. Number 3, bullish percent index, BPI, measures the percentage of stocks on a given index with bullish patterns. Number 4, AAII sentiment survey, a weekly survey by the American Association of Individual Investors, gauging market sentiment. By tracking these indicators, traders can get a sense of the market's mood and adjust their strategy accordingly. Now, let's talk about sentiment-driven trading strategies. These strategies can help you make informed decisions based on the market's emotional state. Here are some popular ones. Number 1, contrarian strategy. This involves going against the prevailing market sentiment. If the market is overly bullish, a contrarian might sell or short stocks, anticipating a correction. Number 2, momentum trading. This strategy capitalizes on the continuation of the existing market trends. If sentiment is strongly bullish, momentum traders buy into the trend, riding the wave of optimism. Number 3, news-based trading. Using sentiment analysis tools to react quickly to breaking news that can affect market sentiment. Positive news might prompt buying, while negative news could lead to selling or sorting. These strategies are all about timing and understanding the emotional flow of the market. And there you have it. Folks, market sentiment analysis is a powerful way to get a pulse on the market's mood and make smarter trading decisions. By using the right tools, monitoring key indicators, and employing sentiment-driven strategies, you can navigate the financial markets with confidence. So, traders and future Wall Street wizards, let's dive into the world of advanced chat patterns, the secret language of the market that can transform your trading game. So, grab a notepad and let's get ready to decode the charts. First up, we have the classic head and shoulders pattern. Imagine a silhouette, left shoulder, head, and right shoulder. This pattern is like the market whispering, "Hey, a reversal is coming." When you spot this, it's a signal that the current trend is about to take a U-turn. Think of it as the market's way of saying, "Heads up, it's time to switch gears." Notice how the middle peak or the head is higher than the shoulders. This formation indicates that the bulls tried to push higher but could not sustain it. Once the price breaks below the neckline, it's typically game over for the uptrend. Let's talk about the cup and handle, a pattern that's as satisfying as a morning cup of coffee. This pattern signals a continuation of an uptrend, resembling, you guessed it, a cup with a small handle. It's like the market taking a quick sip before surging ahead. Here, the cup shows a period of consolidation, where the market takes a breather. The handle represents a short pullback, and when the price breaks out of this handle, it's often time for a bullish run. This is your cue to buy and ride the wave. Now, let's double with the double tops and double bottoms. These twin peaks and troughs are pivotal reversal patterns. A double top looks like the market hit the ceiling twice and just could not break through, indicating a bearish reversal. On the flip side, a double bottom looks like the market found a strong support level twice, signaling a bullish reversal. When you see a double top, it's time to consider selling or sorting, and with a double bottom, it's usually a green light to buy. These patterns are the market's way of setting clear boundaries, and you will want to be on the right side of that line. Finally, let's capture the plug and wave the peanut. These patterns are short-term continuation patterns that occur after a strong price movement. They are like pit stops before the market continues its race. A flag looks like a small rectangle slanting against the prevailing trend, while a pennant looks like a tiny symmetrical triangle. Both patterns indicate that the market is catching its breath before continuing in the direction of the previous move. When the price breaks out of these formations, it's usually time to jump back into the trend with confidence. By mastering these advanced chart patterns, head and shoulders, cup and handle, double tops and bottoms, flag and pennants, you will be equipped with a powerful toolkit to predict market movements and make strategic trading decisions. Remember, the key is to stay observant, be patient, and let the patterns guide your trades. So, traders and market enthusiasts, let's dive deep into the fascinating realm of seasonal trading strategies, where the patterns of nature meet the pulse of the market. Have you ever noticed how certain times of the year seem to have a magical impact on the stock market? Just like the changing seasons, the market has its own rhythms and cycles. And guess what? Understanding this can give you a trading edge. Let's start with winter. Picture this. It's December, holiday, cheery in the year, and the market is buzzing. Historically, the end of the year is known for the Santa Claus rally, a phenomenon where stock prices often rise in the last week of December through the first couple of days in January. It's like a gift from the market to traders. This rally is driven by optimism, holiday bonuses being invested, and overall positive sentiment. Smart traders plan for this, positioning themselves to ride the wave of holiday joy. As we move into spring, we encounter another integrating pattern, the January effect. This is when stocks, especially in small caps, tend to surge. Investors sell up underperforming stocks at the end of the year for tax purposes and then reinvest in January, driving prices up. Spring is a time for new beginnings, and for traders, it's an opportunity to capitalize on the fresh influx of investments. It's all about timing and understanding these seasonal anomalies. Summer, the season of sunshine and flower markets. Yes, the summer doldrums is a well-known phenomenon where trading volumes often dip as many traders take vacations. But savvy traders can find opportunities even in the quietest times. Use this time to do your research, refine your strategy, and maybe even spot time undervalued gems while everyone else is away. Remember, every season has its own unique rhythm. Finally, autumn, the back-to-school season, is also the time when traders get back to business. Historically, September has been one of the weaker months of the market, often leading to increased volatility. But come October, the market tends to rebound. Prepare for this volatility and use it to your advantage. It's the perfect time for strategic plays and setting up for the year-end rally. So there you have it. From the cheerful alleys of the winter, of the quiet opportunities of summer, and the market dances to the tune of the seasons. By recognizing these patterns, you can draft strategies that align with the natural flow of the market. Remember, successful trading is not just about reacting to what's happening now, but anticipating what's to come. Embrace the seasons, study the patterns, and let the rhythms of the year guide your trading journey. So, final adventures, let's dive into the fascinating world of market psychology. If you have ever wondered what drives the dizzying heights and gut-wrenching lows of the stock market, you are in for a treat. We're going to explore the powerful emotions of fear and greed, the integrating phenomenon of hard behavior, the bold moves of content investing, and the sneaky little behavioral biases that can make or break your investment decisions. So, buckle up and get ready for a thrilling ride. First up, let's talk about the dynamic duo that rules the market: fear and greed. Imagine them as the twin engines of a roller coaster. When greed takes over, investors push prices to dizzying heights, driven by the desire for more and more profits. It's like gold rush where everyone wants to get in on the action. But what happens when the music stops? Fear sets in. Suddenly, the same investors who were once euphoric start panicking. They sell off their assets, trying to salvage what they can, causing prices to plummet. This fear-greed cycle creates the wild market swing to which we see so often. Now let's move on to hard behavior. This is when investors move together as a group, when often driven by the belief that if everyone else is doing it, it must be right. It's like a stampede. Once it starts, it's hard to stop. But here's the catch. Following the herd can lead to bubbles and crashes. Remember the dot-com bubble? The housing market's crash. These were classic examples of hard behavior gone wrong. So how do you avoid getting trampled? By thinking differently. This brings us to content investing, the art of getting against, the art of going in. Contrarians thrive on finding opportunities, while others see doom and gloom. It's like being a lone wolf in a city of sheep. Content investors often buy when others are selling and sell when others are buying. It's not always easy, and it takes nerves of steel, but the rewards can be tremendous. Just ask Warren Buffett, who famously said, "Be fearful when others are greedy, and greedy when others are fearful." Finally, let's talk about those sneaky behavioral biases. These are the little mental shortcuts our brains take that can lead us astray. Overconfidence can make us think we are invincible, while confirmation bias can lead us to seek out information that only supports our existing beliefs. And then there's loss aversion, the idea that we feel the pain of losses much more than the joy of gains. This can make us hold on to losing investments for too long, hoping they will bounce back. But here's the good news. By understanding these biases and the psychological forces at play, you can make more informed, rational decisions. Knowledge truly is power. So there you have it, folks. And insight looks at market psychology. By recognizing and understanding fear and greed, hard behavior, content investing, and those specific behavioral biases, you can navigate the market with greater confidence and clarity. Guys, at the end, we have something truly special for you. Now we are diving deep into the real world examples of case studies and success stories that showcase the power of advanced trading strategies. So, if you're ready to be inspired and learn from the best, stick around. First up, we have the legendary Warren Buffett, known as the Oracle of Omaha. Buffett's strategy is all about long-term value investing. But how did he become one of the richest people in the world? Let's take a look. In the 1960s, Buffett started buying shares in a struggling textile company called Berkshire Hathaway. Instead of focusing on the short-term troubles, he saw potential for long-term growth. Fast forward to today, and Berkshire Hathaway is a powerhouse conglomerate worth over $600 billion. Buffett's secret? Patience. Through research and investing in business, he understands and believes in. Buffett's story teaches us that success in the stock market is not about quick wins. It's about strategic, informed decision and having the patience to see them through. Next, let's talk about the tech boom and one company that capitalized on it like no other. Apple. This is a tale of innovation, risk-taking and incredible returns. When Steve Jobs returned to Apple in 1997, the company was on the brink of bankruptcy. But Jobs had a vision. With groundbreaking products like the iMac, iPod, and ultimately the iPhone, Apple transformed the tech industry. Investors who recognized this potential and bought Apple stock in the early 2000s saw their investors multiply many times over. For example, a $1,000 investment in Apple in 2003 would be worth over $400,000 today. Apple's rise demonstrated the importance of recognizing innovative potential and being willing to invest in visionary leadership and cutting-edge technology. Now, let's turn to Ray Dalio, the founder of Bridgewater Associates, the world's largest hedge fund. Dalio's approach is all about diversification and risk management. Dalio developed what he calls the all-weather portfolio, designed to perform well in any economic environment by spreading investment across different asset classes, stocks, bonds, commodities, and more. Dalio minimizes risk and ensures steady returns. This strategy has helped Bridgewater weather financial storms and come out stronger on the other side. Dalio's success story highlights the importance of diversification in protecting your investments from market volatility and ensuring consistent growth. And finally, let's look at a more recent and highly unusual success story, the GameStop saga. This is a perfect example of how social media and collective action can disrupt traditional market dynamics. In early 2021, a group of retail investors on Reddit or Wall Street Bets took on Wall Street by buying up shares of GameStop, a struggling video game retailer. Their collective action caused a massive short squeeze, skyrocketing the stock price from under $20 to nearly $500 in a matter of weeks. While some made fortunes, others faced significant losses, highlighting the volatile and unpredictable nature of such market movements. The GameStop saga is a fascinating case of how modern technology and community-driven investing can create an unprecedented market phenomena. It serves as a reminder of both the opportunities and risks in today's stock market. So, what we can learn from the stories, whether it's Buffett's patient value investing, Apple's innovative breakthroughs, Dalio's diversified risk management, or the GameStop revolution. Each example offers valuable insights. The key is to stay informed, be strategic, and never stop learning. Thanks for joining us on this journey through some of the stock market's most intriguing success stories. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and ring the bell for notifications. And share your thoughts on the comments below. What's your favorite stock market success story? Until next time, happy investing.